Hello everyone, welcome back. I got some really good ones for you today on this Thursday, March 28th, 2024. A lot's been going on with the markets, and that's what we're going to be focusing on for today's video. So welcome back. Glad you made it. Glad we could hang out together, and let's dive right into these markets, shall we? Start with the bond market. We always start with the bond market because it's the largest market on planet Earth. Total market cap, if you were to include all the layers of derivatives, we're probably talking about 150 to 200 trillion dollar bond market. Put things in perspective, you guys, the US stock market total market cap is probably only like 50 or 60 trillion. US real estate 50 or 60 trillion. So the US bond market is, 4 or 5, 6 times the size of the US stock and real estate markets. So action in the bond market is ultimately going to decide what happens to these markets. We've got a 10-year yield right now hanging out at 4.2%, stable, which the markets really like that. I think the 10-year yields remain pretty stable, maybe come down a little bit after that Fed meeting as the Fed kind of chambers interest rate cuts going forward and kind of gets the markets on more or less a easing posture, getting ready to cut those interest rates, getting ready to see the dollar kind of weaken, bond yields come down. That's kind of kept the bond market stable. The bond market knows interest rate cuts are coming, so it's kind of staying steady here at 4.2%. Now, for example, if the Fed had come out last week, real hawkishness, and they were talking about raising interest rates more and getting, really cranking down on getting that inflation under control, bringing down inflation, we would have seen the 10-year yield continue to rise, and then this would kind of put downward pressure on the three major U.S. stock indices. Real estate. So you see, guys, how there's kind of that connection between the largest market on the planet and what that really does to all these other markets like the equity market, so on. So got a 10-year yield that's stable. Markets like to see that. We're closed tomorrow, so happy Easter, you guys. I hope you really enjoy your holiday weekend. But let's say, for instance, next week on Tuesday, the 10-year yield, which is right now at 4.2%, it spikes up to, call it 4.35%. A 15 basis move, spike to the upside quickly would kind of freak out the stock market. So you would look for that stock market, those stock prices to potentially fall. Now, it's not like every time the 10-year yield goes up, stocks have to come down, but there's a very, very close relationship between the debt market and risk, and we need to start with that when building a framework and really pay attention to that, and then we can get into the nitty-gritty on like what Bitcoin's doing and why. So start with that bond market. But yields are stable. We still do have a 2-year yield at 4.6% and a 10-year at 4.2%. So we still do have an inverted yield curve, just pretty deeply inverted. But for a yield curve inversion to lead to a recession, I want to actually see the yield curve uninvert, and then we can talk about like kind of freaking out about a recession. So as long as this yield curve remains inverted, I'm kind of on recession watch, but I'm not freaking out, you guys. I'm not out here like dumping all my energy in high growth tech and crypto and precious metals because the 10-year yield is in the 2 and the 10 are inverted. Like that's not reason enough. But an inverted 2 and 10 does make me want to go up into the crow's nest and just kind of monitor. Does it become more deeply inverted? Will it uninvert itself and then we have a recession? So the inverted yield curve as a leading indicator for recession, it is pretty reliable of an indicator, but it's only one, right? So nothing's really changed here. I'm not out here to freak you guys out. I still remain bullish and constructive, high growth tech, energy, crypto, precious metals. This channel, you guys, has been crushing it. All right, since the inception of this channel, really, we've been calling things pretty correctly. So, I invite you to take a look at any of these older videos and ask yourself, like, was he on it? Like, was he calling it? And when I'm wrong, throw garbage at me when I'm wrong. Drop a comment. Keep me in check, kind of thing. Keep me humble. No, always stay humble, you guys. You win some and you lose some. So moving on to the 3 major U.S. stock indices, we have the S&P 500 closing at 5,254, NASDAQ 16,379, Dow Jones, that tried and true Dow Jones, hanging out at 39,807. Man, tentatively bullish. So I'd like to see the Dow Jones take a stab at 40,000, maybe pass above 40,000 as early as next week, and hold that. We'll see. So that'll be a pretty big milestone, you guys. These three major indices, they're regularly pushing into all-time record high territory. Sure, we're getting some pretty good GDP numbers, decent, but if you were to strip out government spending, these wars, this GDP would really be struggling, guys. Basically, the GDP might be looking pretty good right now, like 3.4% or 3.6%, whatever we're getting for GDP numbers today. But you have to factor in weakness in the dollar. You have to factor in that inflation. So if you were to strip deficit spending out, I don't really know. The GDP would probably be negative, or we'd just not be growing at all. Like we're just kind of holding at the flat line. But a lot of fake money continues to enter the beast system. The beast system continues to feed on the meat of the middle class and dead Ukrainians, which is super sad, you guys, or what's going on with Israel and Hamas. Like a lot of that is the beast system feeding. I mean, we've had a lot of drama around Boeing, and that thing, that stock price just can't be bothered. You know why? Because 90 or 96% of Boeing's revenue comes from government contractors or government contracts, and Boeing is a monopolist in the space. They're doing a lot of dirty work on behalf of the U.S. government. That's kind of what I'm getting at. To include like some of the tracking systems on the bombs and stuff, you guys, Boeing's out of control. Same with Raytheon, Lockheed Martin, Northrop Grumman. These are like defense contractors that have like the directed energy weapon that, either started that fire in Maui or just, can send a beam down from the clouds and murder somebody, Pretty crazy stuff. I do wonder who developed the R9X rocket. Look up the Ninja bomb, you guys. It's a missile that doesn't have a warhead on it. It right before it hits the target, it flings out blades. It's basically like a ninja bomb, a sword missile. Like it doesn't shoot the blades out, but the blades fling out and then hit the target. So it kind of slices and dices the target without an explosion. That's supposedly to reduce collateral damage. But think about it, you guys. We have drones that shoot knives out. You know what I mean? Like that's some pretty gnarly stuff. So, I don't know how we got on the R9X rocket, but totally Google it. You guys, let's do a quick bit of housekeeping. You don't have to watch me on this channel kind of brief you guys. Just put the device in your pocket or whatever, and you can go do laundry or mow your lawn or whatever it is, because I'm not really showing you guys charts. Another thing you could do is whenever I say something, just Google it. So for instance, that R9X rocket, just go ahead, sit there on your computer, throw up a search window, R9X rocket kind of thing. And that way you're kind of fact checking me as we move along. You guys might want me to put like charts up on the screen, and maybe we'll dabble with that. I do have a nice webcam and a pretty good monitor setup and things like that, but I don't want to get too stuck into editing, you guys. Like I don't want to have to do like post-production and have all these like a mic and all these moving parts. I'm doing all of this on my phone in one take and then uploading it to YouTube. So, if there's a format you'd like to see me attempt, you can drop a comment. We probably will mess around with format, like the format of the channel. I kind of want to do some things outside of the channel too for you guys, but for now, just kind of treat this like a podcast or something, So just listen and then maybe look things up as I talk about them. But anyway, moving on, those three major indices, they had a pretty flat day today, but near and pushing into all-time record highs. So pretty wild. Dollar slightly up today, but like nothing crazy, pretty much flat. Gold and silver up nicely today, about 1% each. We got Bitcoin up nicely, hanging out at like 70,759. We briefly dipped back down into the 60s, but now we're back over 70. So we'll just have to see where that goes. But I like Bitcoin on this channel. That this channel has been shilling Bitcoin since its inception. I mean, I have headlines, $20,000 Bitcoin. Just scroll down, you know what I mean? So we like Bitcoin. We still like Bitcoin. Keep stacking those sats. I think 100,000 would be a pretty good medium-term price target. We might hit 100,000 Bitcoin like in November. I could see something like that. But that doesn't really concern me because over the course of my life, by the time I'm grayed out, I'd like to see Bitcoin at 1 million. I think that's very doable, you guys. And you might be like, dude, why? Like, justify that. Okay, let's do that. So what's the market cap of all the Bitcoin right now? About $1.5 trillion. If Bitcoin flips gold, that will send Bitcoin from a 1.5 trillion market cap to about a 13 trillion market cap. That's like another 5-10x from here. You know what I mean? So if Bitcoin can just flip gold, which it's well on its way to doing, that'll get you close to 1 million. And then you have to factor in all the just D-dollar valuation as we have these business cycles that last about 6 to 9 years of expansion, 2 to 4 years of recession. Well, over the course of that full cycle, a lot gets added to the money supply in terms of dollars each time. So median home prices right now are hanging around 400,000. We could be in a situation in 15 years from now where median home prices are 1 million and Bitcoin's already has a 10 trillion or 15 trillion market cap. That would put it around there. So there you go. I can rationalize $1 million Bitcoin, you guys. But is it going to happen in this cycle? Highly doubt it. If it did, like let's say next week Bitcoin trades to 1 million, well, that's just the US dollar ceasing to function as a currency. Something would have happened to the dollar to the point that it's just been destroyed so badly nobody really wants to use it at all. That could put Bitcoin at 1 million. That would put your gold at like 5,000, 10,000, 25,000 if the US dollar ceases functioning as a currency. But do I think that's going to happen? No, especially given our conversation about Boeing, our monopoly on the use of physical force. There's a whole litany of reasons why the dollar empire still got some life left in it. But make no mistake about it, you guys, that dollar has just been getting beaten up for years and years and years. And that's what's putting the stock market at all-time highs. That's what's putting Bitcoin at all-time highs. People want to say, oh, it's a everything bubble. Well, if everything's in a bubble, I'm here to tell you nothing's in a bubble. And you're probably just looking at the situation incorrectly. Like you can have all these asset classes that are sharing a pretty close relationship to one another. And then if one is like way up, way up over the rest, well, that kind of makes me think maybe you could have a bubble on your hands. But if everything's in a bubble, guys, I'm here to tell you that's just the currency getting beaten up, okay? That's dollar weakness making the price of everything from a stock to a Bitcoin to an ounce of gold to a barrel of oil to your left shoe 40% more in a matter of like 4 years since COVID, you know what I mean? So I don't think we're in an everything bubble. I think the dollar and the US standard of living was the bubble and it has burst, and now it's hard to find much of a happy middle class here in the United States. It's like if you don't want to be rich and you don't want to be poor, well, you don't have a choice. It's like you're going to have to pick one. You want to be rich in the United States or you want to be poor? Because the way things are going with monetary policy, the way the dollar continually gets driven into the dirt and pushes all these markets, real estate, you name it, higher and higher and higher, it prices the middle class out of social upward mobility. It just, when the US dollar was very strong in the 50s and 60s, we had a very, very strong middle class. There weren't a lot of people that were super, super, super rich, and there weren't a lot of people that were super, super, super poor. The currency had purchasing power. A man could go work at a grocery store and provide for a wife and kids at the house. The dollar had a lot more oomph behind it, And I'll try to right now solve wealth inequality. My gosh, I didn't know I was going to be going here with it, but this is good, you guys. Just follow me here. You might be thinking, oh, great, you want to solve wealth inequality, so you're going to play that game where you decide how many billions of dollars you print and then give to either some government program that's going to feed the homeless, or what are you doing? What kind of socialist lens are you about to project onto this channel about how to redistribute the wealth? Guys, I don't even want to, we don't even need to do that. To solve wealth inequality in the United States, this is what we need to do. I'm gonna lay it out for you, and drop a comment if you think I'm over the target or if I'm totally wrong, but this is how I would solve wealth inequality. I would make the official stated inflation rate asset price inflation. So follow me here. We're in a situation right now for the last 30 years where every year wages have gone up 2 to 3% and asset prices 6 to 12%. You compound that regime, that mechanism for like 30 years, you end up in a situation where asset prices are in the nosebleed and wages aren't buying any of these assets anymore. We're there. The rich people stuff went up 6 to 12% per year for 30 years. The wages barely moved. Run the clock out. And you might be like, well, why did that happen? How come there weren't years where like wages went up 10% and asset prices came down 10%? Well, maybe there kind of was. Like I'd say 2008 was like one year where maybe the middle class started to kind of get ahead as these markets came crashing back down to earth. But net, the Fed is always printing money and always understating inflation. So the name of the game is print rich people stuff 10 to 12% higher every year, real estate, gold, and then tell everyone the official inflation rate is like 2.8%, what they're doing today. And then tell people, well, inflation's only 2.8%, so we're going to raise your wage like 2.8% this year. See? But guys, you see the PSYOP was in the stated inflation rate. If the stated inflation rate was rich people stuff, then it would be like 12% a year. And if inflation was 12% a year right now, then the Fed would not be in a position to be cutting rates in May. The Fed would have to say, inflation's 12%. I have to raise the Fed funds rate to 13%, putting mortgages at like 14, 15, 16% to get inflation down. And if we were to do that, if the Fed funds rate were to go to 13%, that would crash everything. Everything would come back down. You know, you'd be able to get 10 shares of Tesla for like $100, 10 shares of Home Depot for like $100, 10 shares of Amazon for like $100, 10 shares of Google for like $100, 10 shares of Boeing. You get the idea. Everything would come crashing down to earth so that you could go out with your $15, $20 an hour job and actually buy a big percentage of the market. So for 30 years now, because of embedded growth, and here's why equities have to go up 6 to 12%, guys. So the plot thickens. Why do they have to? They have to. Have you noticed that even if we don't have growth, the Fed will make sure, hell or high water, the stock market goes up 6 to 12% per year. They have to because they have an embedded growth obligation. All your 401ks, all your pensions, like the whole Ponzi, the whole system is predicated on an embedded growth obligation of like 6 to 12% per year in the equity markets. And if they don't get it, they will print the money to get it. And that's what they've been doing, guys, forever. Not to mention when we go into a recession, I told you like back in 2008, you had a chance for the middle class to actually get ahead. Well, they added like 20, 30% to the money supply right after via QE 1, 2, 3, and 4. So what I'm getting at, guys, is we don't need to redistribute the wealth. What we need to do is make the currency, the dollar, strong again. And what does that look like doing? Raising interest rates on dollars above the inflation rate to break the back of inflation. But the Fed does not want it. They want to tell you inflation is it's way low, so we don't really need to raise interest rates. We can keep interest rates low. We can keep fostering this eternal gigapump in the markets, and we can give people like a 2% pay raise. So here's how to solve wealth inequality for yourself. Your pay needs to be based on the average of the S&P 500, Bitcoin, gold, and real estate. Take how those benchmarks are doing every year, average it out, call it 9% a year. Your wage needs to be going up 9% a year. Because the second it's not, the second you're only going up 2, 3%, you're falling behind. Play that out for 30 years, you're in a situation now where you cannot get the dollars you need to buy these nosebleed assets. So solving wealth inequality, guys, could be done by sound monetary policy and policy makers and politicians that level with you. But they won't. They lie. They foster this eternal gigapump. They tell foreign investors, hey, if you buy U.S. equities, you don't have to pay capital gains tax on that. So all these other rich people the world over come to the U.S. equity markets, the U.S. stock market. I mean, Tina, there is no alternative. So they show up in droves, they pump our markets, and they don't have to pay capital gains tax on that. And meanwhile, you're just getting flushed and left behind because you still think that $20 an hour is going to cut it, and you're slowly realizing it in 2024, $20 an hour is like the new 10. And you know what's crazy, guys? I would totally be cool, me personally, getting paid $10 an hour if the Fed took interest rates above the inflation rate. So if the Fed said on Tuesday next week, or whenever, hey, we're going to actually make asset price inflation the stated inflation rate, and we're about to take interest rates way up to break the back of inflation, guys, everything would crash, and then $10 an hour would actually buy you a lot of stuff. So you see how it's like it's a psyop, it's a woo-woo, it's a fugazi, it's up there, it never landed. Like, these markets just go up, 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 and up. And you might be thinking, when is this market going to mean revert and like crash back down? It's a debt-based monetary system, so you got to know what you're looking at. Like, if you bring up a chart of the Home Depot and you look at the 10-year chart, it's not going to be going up linearly, because we're on an exponential. We have a debt-based monetary system that requires that more and more be printed in perpetuity just to remain where you are, never mind additional growth and productivity. So put another way, what happened in COVID? We added 40% to the money supply. It was like $12 trillion. Okay, cool. Next recession, we'll call it 2029. They're not gonna print 12 or 14 trillion. They're gonna print like 20 trillion. And what do you think the national debt's gonna be by 2029? Probably like 50 trillion. I mean, we're close to 35 trillion now, and we're on an exponential, guys. That's really the key takeaway there. Is so when you bring up these stock charts and they look like they're hockey sticking and going up exponentially, don't expect that to change as long as you have a debt-based monetary system, which will happen eventually. But everything's kind of on an exponential here. It's you add 8%, then add 8%, then add 8%, then add 8%. You do that to the S&P 500 for like 20 years, yeah, you get what we have today. And then you look over at like the real economy with entrepreneurs and wages, and you're like, dude, you need to catch up. But also part of the psyop is they pretend like those worlds are like they're like mutually exclusive, like they exist in the vacuum of space, and it's not true. So put another way, if you own a restaurant right now, you know what your profit margin is? It's like 3 to 6%. Or you own a grocery store, you know what your grocery store margin is? It's like 1%, guys. That's like a 1% per year profit margin business. So what happens when the Fed adds 40% to the money supply and inflation's now 40%? That grocery store is at a negative 39% profit margin. And then they have to like start raising prices a lot just to stay alive, but they generally don't. They generally go like, oh, I don't know, that's the stock market. It goes up and it goes down. But you know what? Cereal is still $3, and they just get flushed. Those people, you own a restaurant, 6% profit margin, cool. COVID happened, negative 34% from 40% inflation. So you have to raise your prices now 34% just to get back to even, let alone get your profit margin, like clear the hurdle rate and actually make more profit on top of that. So these restaurateurs and these owners of grocery stores, they pretend like the stock market is just something out there, woo-woo, but they don't understand that the stock market, like the Dow Jones, is at 40,000 because the dollar's that weak, and that an ounce of gold is now 2,000. A new car is like 50,000. A new house is like 400,000. One Bitcoin is 70,000. And these aren't bubbles. It's the dollar getting incinerated. And then these guys are like, well, I don't know. I'm going to keep paying you $25 an hour. Guys, do not surround yourself with those people. Surround yourself with people like the people on this channel that kind of, we have kind of a handle of what's going on. And we're just going to ride out and we're going to keep winning. We're going to stay long that Bitcoin. We're going to stay long that mega cap energy, mega cap tech, precious metals. Or not, do your thing. Nothing's a buy or sell recommendation, but that's what I'm doing, you guys. So we got Sam Bankman-Fried getting sentenced. So Sam Bankman-Fried, for the fallout of FTX, he's getting into a little bit of trouble. Looks like he's going to prison for like 25 years. It'll probably be 12. Okay, that's generally how that works. But his lawyers were pushing for only like 5 to 7 years, and he's looking at like 12 real ones, maybe up to 25 years, but I guess it's usually like half the sentence is what they end up serving. But we'll just have to see with old SBF of FTX and Alameda Research. Is such a weird girlfriend. Check out Alameda Research, Sam Bankman-Fried's girlfriend. Guys, Sam Bankman-Fried's parents did try to throw a Hail Mary recently, where they were like, he's autistic, like he's there's something wrong with him. It's not his fault. But guys, he's going to take responsibility for this. 28-year-old, he made $28 billion just kind of poof into thin air, created like a black hole in the crypto market. I mean, it really it's turned all my bags into rugs for a couple years there. But hey, we got through it. SBF's being held accountable. but man, it's a cesspool in there, guys. Qcoin, same thing. Exchange just got caught laundering like $9 billion. Crypto is full of bad actors, okay? So let's talk about some of the good ones because there aren't many. I like Brian Armstrong, the CEO of Coinbase. He seems like a pretty straight shooter. I like Sergey, I don't know how to pronounce his name, but the founder of Chainlink Labs. I think Charles Hoskinson over there at Cardano's, he's okay. We'll keep an eye on him. But I do like Brian Armstrong, really. If we look at these other crypto exchanges, guys, Binance, I like Binance, but it doesn't serve U.S. customers. And some people think CZ, the founder of Binance, is shady. But I don't mind Binance. If I lived in another country, I would be using Binance. They're monolithic. They're huge. They're probably not going anywhere. So you have Binance, and then you have Coinbase for U.S. customers. I'm a big fan of Coinbase, you guys. If you don't own any crypto and you're looking to get involved, I think the best way to do that is through Coinbase. It's a custodial wallet. They can kind of help you out with that. If your Bitcoin like disappears, there's a number you can call. It's a custodial wallet. You know, Coinbase is interesting. What Brian Armstrong does there over at Coinbase is mainly, what he does is he goes out into the crypto market and he buys tons of these tokens. And then you buy these tokens off Coinbase. So you're actually buying Coinbase's tokens that they've already bought. And then they make a small amount on that transaction. So they're a custodian, you guys. So big fan of Coinbase. They really haven't messed up yet. But Qcoin just got in trouble. Sam Bankman-Fried just got in trouble. I do not trust the Winklevoss twins there over at Gemini too much. I don't know enough about Kraken. So yeah, it just leaves me with Binance and Coinbase, and Binance doesn't offer services for U.S. customers. So Coinbase, guys, Coinbase looks to be your monopolist crypto custodian, and they're publicly traded. You can own Coinbase if you'd like, or not. You know what I mean? It's been a wild ride, but if you don't want to gamble in the shitcoin casino, you can own the casino, and that would look like owning shares of Coinbase. Kind of Brian Armstrong would be your guy. You know, you'd be on Team Brian, but he's all right. So yeah, that's kind of your down and dirty on the crypto exchanges. I guess we can talk a minute about crypto wallets, and then I'll let you guys go. I do like the Coinbase wallet. So there's Coinbase wallet and then the Coinbase exchange. I know this gets kind of confusing. Sign up for Coinbase like you would regular banking. Just create your little login and password, get all set up, link it up to your bank. You can start buying cryptos with Coinbase. But if you buy those like Bitcoin on Coinbase, the app, which is fine, that's sitting on the exchange. And then if you want, you can download Coinbase wallet, and then you can move your Bitcoin from the Coinbase exchange to your Coinbase wallet. You can also look at like MetaMask. MetaMask is a non-custodial wallet. I use Coinbase. I use MetaMask. MetaMask is an Ethereum wallet. So if you own like Solana or something, it's not really going to work with MetaMask. But if you like Ethereum, you like some of these ETH coins, like, you know, Chainlink or I don't know, whatever, Pepe. I love Pepe. So, you know, you can hold that on a MetaMask wallet. MetaMask wallets are very safe. Coinbase is very safe. Anything can happen, though, you guys. It's the Wild West. So I don't want to come out here and be like, wow, he told me that MetaMask was safe, and then I got drained for $10,000. Like, I don't want to hear it, you guys, but Coinbase is safe. MetaMask is safe. Another wallet I got recently so that I could buy Harambe coin, Phantom wallet. So Phantom wallet is a Solana wallet. I have a Phantom wallet. I have a little bit of Solana in there, but mainly I got that wallet so I could buy Harambe coin. You can't hold Harambe on MetaMask because it's not an ETH coin. Harambe is a Solana coin. It's Harambe on Solana. So I had to get a Phantom wallet because Coinbase doesn't support Harambe yet, and MetaMask isn't ever going to support it probably. So yeah, these different wallets do different things. There's also hardware wallets, but I don't have any of those, any experience with that, so I couldn't really speak to that. Some people think like they're being safer on a hardware wallet, but the reality is somebody could have already like programmed a backdoor into that hardware wallet, so I don't really know. I think Coinbase is safe, you guys, and I think MetaMask is safe. And I think if you Google, are these things safe, you're going to get a yes. You're going to get a thumbs up from people. But I recently did, like a few days ago, download a Phantom wallet, bought some Harambe. So Solana has these meme coins coming out. dog with hat, kind of Harambe. I only picked Harambe for the Solana meme coins, but other meme coins I have would be on the Ethereum blockchain. So Pepe, okay, still got a whole bag of Pepe. Pooh, like Winnie the Pooh, that's an Ethereum coin. I own like 25 billion of those, like 25 billion Pooh, you guys. 900 and something million Pepe, somewhere in there, you know. Yeah, and then I have about 12,900, something like that, Harambe in my Phantom wallet. So those are my 3 meme coins, you guys. Pepe, Pooh, Harambe. And then I've kind of gone in and out of Clown Pepe, but I don't want to get back into Clown Pepe because I've made a lot of money on it, and I don't want to like give all those gains back. So be very careful with the meme coins, you guys, but I do like meme coins. Check out Pepe, check out Harambe, check out Winnie the Pooh coin. That's really all I got for you guys for right now. And those aren't buy or sell recommendations, you guys. Meme coins are nitroglycerin, but hey, it was all a meme. It was all a meme. Everything's a meme. It's all a meme. I'm just gonna leave you guys at that. That's a deep thought. Like I really want, let that marinate, okay? Gold, Apple stock, Exxon stock, the house down the street you're about to buy. It was all a meme. It was all a meme. Hope this video finds you doing well. I hope you have a wonderful holiday weekend. Thanks for hanging out with me, you guys. Like, subscribe, comment, share, whatever. You guys are awesome. Let me know, did I solve wealth inequality, or am I on to something here, or am I totally wrong? Am I right? Am I wrong or right about anything kind of thing? Let me know, you guys. Till next time.